Hi. I'm just wondering, Cindy, if this is going to be wrong for me to be signed in to your account for the Zoom meeting or to do the breakouts and things. I mean,
you to start the next slide. Hi, everyone, and welcome to today's session. I'm just throwing a poll up for you right at the start here while we get things underway. My name is Cindy Lindsay, and I'm the co-director of Learning and Network Engagement for Community Foundations of Canada, along with my colleague, Tracy Vavrick. Say hi, Tracy.
Good day, everyone. Nice to see you.
Yeah, and so before we get started, we've got a few things to just go through, but I would like to share with you that I am connecting with you all from Treaty 3 territory on the traditional lands of the Haudenosaunee, Anishinaabe, Attawandarak, and the Mississaugas of the Credit First Nation. As a settler, I am committed to continuing my learning about how I can be a better ally to Indigenous communities, not only in my own home community, but across the community or the country, and how I can advocate for meaningful decolonization efforts. And so I'm just sharing with you about my own personal journey and commitment around reconciliation and our land acknowledgement. So, can people see the poll before we kind of get underway?
Yes, I can see it, Cindy.
Okay. I'll just do the end poll and see what we've got here. I don't think, Tracy, I can't see the results of it, so you're going to have to do that for me.
Okay, so we have 55% are executive directors, and with 18% are our finance team, and we also as well in regards to management have another 18%. And then we have a 9% at others. So looking at these results, very high in the leadership component of either finance or the executive director CEO. Yeah, just closing it.
And that's great. So we've got a nice mixture of people. Wonderful. Next slide, Gord. So in coming from various aspects of our work, and we know for some executive directors that also means that you're doing it all as well. So just a couple of housekeeping items, as I mentioned, we ask that everybody be on mute for now, but we'll have lots of opportunity for you to unmute yourselves and have conversation. Feel free to use the chat box function if you want, if you have any questions. We will be going into a breakout room at some point during this and having a short break. This is a little longer presentation because this is first of a three-part series where we go a little deeper into our work as community foundations around finance and the role of a treasurer as well. And so, so we're aiming for 90 minutes. We may finish a bit early, depends on how chatty we are, folks, but we'll certainly provide a short break in there as well. We are recording this, and we will share the slides and the recording with you following today as well. So, and also for the best experience, we do ask that you close all your other applications and make sure your volume is up so you can hear us all. Next slide. Okay, so I introduced myself and Tracy, and I know we're a familiar face to many of you. And as we roll out, this is the first of our series of learning opportunities for our Learning Institute for the fall and winter for Community Foundations of Canada. So you folks are kicking off our season, and so you will see lots of Tracy and myself in the coming months. But it's really my pleasure today to introduce our facilitator, Gordon Hawley. Some of you may have heard Gord on other CFC webinars. He did one on the CERB program during COVID, T3010, other financial practices. And he brings just such a wealth of not only financial experience, but also understanding the context around our work as community foundations. And Gord is a board member of the West Vancouver Foundation and of Community Foundations of Canada. And so he's also delivered numerous workshops within our sector, and we're thrilled that he's leading this series with us. So welcome, Gord. And really appreciate you taking the time to share your expertise and knowledge and facilitate this conversation with us. I do want to mention, before we turn it over to you, Gord, that as I mentioned, this is the first in a three-part learning series exploring the fundamentals of community foundation finance and the role of the treasurer. We want to make sure that you have lots of time for questions and answers. This is a very safe space, so if you are like a non-finance person and have a question but you're afraid to ask it, feel free to ask it. Or if you want to pose how other organizations might be doing something, this is your opportunity to do this. So we just want you to get the most out of this time together. So Gord, I am going to turn it over to you now.
Wonderful. Thank you, Cindy, and thank you for your very kind introduction. Just a couple things before we get started. To the extent that there's any legal and tax information in the session today, please don't take it as legal and tax advice. You should always get professional legal and tax advice from your accountants or lawyers. The views expressed here are for information purposes and are entirely my own, not necessarily those of Community Foundations of Canada. I am hoping, as Cindy mentioned, that this will be sort of more of an interactive session today. So please feel free if you have any questions at all. Either just interrupt me. I'll try and make space for questions as we go, but feel free to interrupt if we're leaving an area or leaving a slide that you have a question about. And always feel free to type your questions into the chat box if that's more convenient. Okay, so we are going to have a couple of polls coming up in just a minute, but just to give you a sense of what we're going to be talking about today, we're going to have a general overview of governance at community foundations generally. We're going to talk about some of the risks and opportunities at community foundations, the board financial governance roles and responsibilities, other financial roles and responsibilities throughout the organization, a little bit of regulatory compliance. And we'll raise some of this, we won't have time to dive deep into them today, but we'll raise some of the strategic financial governance issues specifically related to community foundations. And just by way of background, I've got about, I think it's getting close to 50 years of cumulative board experience, and about 6 or 7 of those on community foundations and Community Foundations of Canada. And I have to say, community foundations are by far the most complex organizations I've ever been on the board of. For me, it was a heck of a learning curve. At one point, I think I was treasurer of the West Van Foundation for 2 or 3 years. And there are a lot of issues that come up in community foundations that just don't come up in other nonprofits and charities. So first of all, thank you to all you for all of the hard work that you do in community foundations, and just know that none of these issues that we're going to be talking about today are necessarily easy. If you have questions, it's totally understandable. It took me probably 3 or 4 years before I really started to feel like I actually understood at least what some of the questions we should be asking are. And I'm still learning about what the right answers are. So it feels like it's going to be a bit of a lifelong learning journey. Anyway, with that, let's go on to our next poll. Really interested to know sort of who's on the call today and what size of community foundation you're from, just so I can get a sense of how to tailor the presentation. So Cindy or Tracy, if we can get the next poll up, that would be great.
Tracy, I think you're going to have to pull that poll up. It's not letting me go past the first one.
It's not letting me either here as well.
Ah.
So I'm not a co-host, sorry.
Okay, all right. Well, let's just maybe have people just pop in the chat box. So what's the asset sizes of your community foundation? And sorry, not the asset size. We asked about the number of staff. So whether you're like less than one, so you're a part-time person, sole employee of the foundation, or if you're more, just to give us a sense of the size and scope of the community foundation.
That would be wonderful. Okay, so for the most part, it looks like we're under 3, certainly under 5, with a couple of larger ones. So that's great. That's very useful. Thank you. Okay, and the next question is, I'd love to get an understanding of everybody's comfort level with respect to financial governance and financial management at community foundations. If you just do it maybe on a very strong, fairly strong, some, not much, or none. Those are the choices. If you could type a response, one of those into the chat box, that would be wonderful. Okay, and the answers seem to be a lot of some comfort and a few very strong, so fairly strongs. Okay, that's great. That gives me a good sense of who's on the line and how I can best target the information today. Thank you for that. Okay, so first of all, I remember out of all the things I've read about community foundations, and this is going back a little ways, there was a brilliant document that talked about what made community foundations different than other organizations. And as I read it, there were 3 main roles. One is endowment building and donor services, and so there's some core competencies that are involved in this. We need to have some kind of core competencies on fund development if we're going to be growing our endowments and growing our pools of funds to grant from. With respect to accountability and transparency, it also means we need to have some core competencies in financial stewardship, in investment stewardship, and in legal stewardship. And we'll talk about examples of those throughout the presentation today. Also means, the community foundations also do broad and effective grant making, which means we need some core competencies in grant management, in fund accounting, and impact evaluation. And the way to communicate the impact that we as community foundations have on our communities is a really interesting issue. Impact is very difficult to measure, but how do we demonstrate that to donors that we're having a positive impact and that their funding will be well used to build resilient communities? And then the third is inclusive community leadership, where we need to have some core competencies in community engagement. So these feel to me like the primary core competencies that we need in order to steward our organizations. And I suspect, hope at some point that this gets updated. I think there's some evolving shifts in thinking about philanthropy and the role of community foundations in philanthropy today that I hope someday will be at least looked at and considered in terms of this overall framework. So one of the reasons we all get involved with community foundations is because there really is an opportunity for us to enhance belonging in communities, but also through the organizations that we grant to, feed people who are otherwise going hungry, house people without homes, reduce poverty, protect the environment, make education more widely available, ultimately growing, having more impact, and ideally in the long-term world peace. But interestingly, as community foundations, that also means we have to think about not only who we're granting to today, but whether or not we have an interest in growing our capacity to have a positive impact on our community. And this gets into a really interesting question around what the appropriate level of overhead and administration, or how much should we be spending on operations, versus how much should we be spending on capacity building? Like if we want to increase the grants over time that we can put into community to have more positive impact, maybe we need to do some capacity building for ourselves and invest in our own capacity and ability to grow and serve more people and have more impact in our community. So there's some very interesting conversations for boards to have around the appropriate level of investment in capacity building at community foundations. And we'll chat a bit about that later on today. So there are, in addition to opportunities, there are also some specific financial risks related to community foundations. First and foremost, and I can't stress this strongly enough, occupational theft, fraud, and embezzlement is a huge risk to community foundations. There have been a number of studies out, we'll talk about a couple in just a minute, that talk about the extent. I just read an update. PwC does an annual global financial crime survey, and I think they're estimating that somewhere between 47 and 50% of organizations have had a significant instance of theft, fraud, or embezzlement in the last 24 months. So we're looking at something like 25% per year. That's a significant number. We know that community foundations are generally registered charities, and so they're not subject to income taxes, but they're still subject to payroll taxes and sales taxes. And I've seen organizations get into trouble around classifying their employees as independent contractors rather than employees. And that's probably one of the singular biggest financial risks, aside from investments, that people have. And if you're ever subject to a payroll audit, they can go back for a number of years and the financial consequences can be significant. So making sure you're on the right side of the employee versus independent contractor, particularly for your executive directors and senior staff, is an important financial issue. Obviously, anything that would lose our stellar reputation as stewards and community builders, losing charitable status. I've seen this happen to organizations just because when they filed their T3010 report, the address they put on was the address of their treasurer, and then when the treasurer changed, they didn't update the CRA records, so all the notices that they were supposed to file their T3010s went to a previous treasurer. The previous treasurer didn't do anything with them. The organization forgot to file their T3010s, and all of a sudden their registration was revoked. Well, if your registration's revoked, guess what? As a registered charity, there's an immediate tax of 100% of all of your assets. You're literally required to donate your assets to another charity or give them to the CRA. And in community foundations, that could be significant investments. So it's critically important that we figure out how to make sure that we're filing the T3010s and doing everything we're required to do to maintain our charitable status. Investment management is also a potential risk. If we're not managing the investments well, donors are going to be hesitant to give us big gifts or small gifts for that matter. Gift agreement non-compliance. Many of our donors at the West Van Foundation enter into significant gift agreements. If they feel like we're not standing by our commitments as outlined in the agreement, they'll let us know and potentially sue us. We've never had anybody sue us to the best of my knowledge, but it does happen. I hear from the lawyers that it happens quite frequently and is one of the biggest sources of risk for community foundation boards of directors. There's always the risk of inappropriate asset use. If somebody gives us assets for charitable purposes and people use them for different things. Oops. Don't touch your keyboard while you're doing a presentation. There we go. Ineffective spending or granting is another risk. So we somehow have to make sure that the grants we're making are effective and that we're making sure that any spending we do is also effective, because donors are going to be watching what we're doing. They're going to be watching how we're spending our money. Board members are going to be watching how we're spending our money, and we want to make sure that we're stewarding the funds given to us by our donors well. And then there's always the risk of reporting errors. The finances in community foundations are very complex, more complex than for most organizations, and we'll talk about financial roles and responsibilities, but reporting errors can happen. And unless you've got some fairly significant financial expertise in the organization, reporting errors could potentially happen frequently. So those are some of the primary financial risks. Does anybody have any questions on those before we move on?
Gord, I'll just share too with the group that we do have a document that we will send out the link to after this around legal issues for community foundations. And so this is a compendium of examples of legal issues that some community foundations are experiencing or have experienced. Most of them revolve around gift agreements or estate issues or fund holders wanting to transfer the assets. And so it's a great, there's I think 4 or 5 different case studies in there. So it's a good document to have sort of in your toolbox in case you come up against anything. So we'll share that with you folks.
Yeah, thanks.
If anybody has any other questions, just feel free to jump in anytime and by unmuting yourself.
Yeah, we had a fascinating conversation the other day at the board because one of our agency donors wanted to convert their endowment fund and take out the cash. And we found out that they're legally entitled to do that. But it raised some interesting questions for our board members because it turns out in their gift agreement, the way it was written, there's basically an amendment clause that allows them to amend the agreement. And so they wanted to take advantage of that, but it raised some interesting questions for us as a board because people had been donating to that fund on the assumption that the capital was permanently locked in, and now the organization's asking for us to convert that so they can go use the funds to do whatever they want. What role do we have to play as community foundations, and do we need to have communications with the donors to the fund, letting them know that this is what their organization's planning to do? I'm not sure there's a right or wrong answer to that, but it was a very interesting discussion at the board. I thought endowments were locked in. I thought once you created an endowment, it was locked in permanently for life, and it would be there forever. Apparently, that's not always the case, so it was interesting learning. Let's see. Oh yeah, so I wanted a couple of examples of occupational fraud. This was actually a Canadian survey done by CGA Canada back in 2011. They found out that across the board, about 26% of surveyed small to medium-sized enterprises, again, reported having a significant instance of occupational theft, fraud, or embezzlement in the past 12 months. The rate was 37% in BC. We think these numbers are, for the businesses, we think they're significantly higher in the nonprofit and charity sector, because typically you don't have that, you don't have the kind of passion or requirement for the business owner to be monitoring cash and knowing where all this cash going. And so often you don't have the same level of oversight in nonprofits or charities. So this is really important. Same, this is at PwC survey, 55% in the last 24 months. So again, about 25 or 30% per year. And again, these are overall businesses, not restricted to the nonprofit sector. We think the nonprofit and charity sector is significantly higher. So financial governance and financial management is critically important to our reputations in our communities. Okay, so let's dive in a bit to financial governance roles and responsibilities. So first of all, we're going to talk about the board, and I'm just going to use I've got 4 roles here, and they all kind of mean the same thing. At the end of the day, we're stewards, we are fiduciaries, we're trustees, and we're guardians. We're given money by one group of people to manage it and steward it on behalf of some other people. Legally, there's a fairly high bar because we are, in theory, representing other people and managing it on behalf of someone else. So the bar as the board in community foundations and other charities is quite high. As board members, we have multiple roles. On the one hand, we're supposed to be supporting our CEO and the staff, but on the other hand, we're also a watchdog. And I'll say that as organizations grow and hire more experienced people, they can generally spend less time in the watchdog role and more time in the supporter role. But as small organizations, we're often required to spend a fair bit of our time in the watchdog role to make sure that the management team is doing everything they need to be doing to protect the reputation of the organization and to protect the assets that have been entrusted to us over time. Now, I think there are three keys to financial governance generally. And I'm going to break them into three areas, and we're going to go into some detail of some of the things boards can do to support each of these three keys. The first one is long-term financial sustainability. So do we have a long-term plan in place, and are we thinking critically about the future of the organization and how we can position ourselves to have the most impact in our community and how we can set ourselves up for success? The second is annual financial performance management. So this is, typically your budget compared to actual, or your cash flow projections, or your scenario planning. What are we doing to oversee, to do some planning for the year in terms of what we hope to achieve, and then to manage our performance against that plan and take any corrective action as required. And then finally, there's an area that we call essentially financial risk management, which is everything we do to protect the assets and reputations of the organization, our community foundations, and its directors. So those are the three areas we're going to talk about for the next few minutes. We're first going to go on to talking about long-term financial stability and sustainability. Here are a few of the things that we can do as board members to protect the long-term financial sustainability of our organization. We can make sure that there's an enduring vision, mission, and values, and some thought about measuring, demonstrating, and communicating the impact we have on our communities. The better we get at that, the easier it's going to be to encourage donors to provide us with the funds we need to do the granting. Having a long-term strategic plan that's refreshed either on an annual basis or every few years is a great way to keep the planning focused on the long-term horizon. Building a case for support. Often that means hiring an outside fund developer to help us put together a case for support that we can put in front of potential donors to give them a sense of where there might be great opportunities for them to contribute to the organization. Doing effective succession planning, making sure that we're doing succession planning at both the board level and the management team level. I mentioned evaluating our impact and our measurement, participating in things like vital signs, which gives us a fairly good tool to identify how vital our communities are and some of the things that we're doing to make them more vital over time. Thinking about our business model and our funding model and the diversity of our revenue streams. Are we relying entirely on large donors? Are we getting funding from other sources? Are we getting funding from our community members? Is there an opportunity to democratize philanthropy in our communities? We'll talk a bit about that later. Benchmarking with other community foundations. We had the pleasure at the West Van Foundation, we raised the question about whether we should be, was it appropriate for us to be spending unrestricted funds on building our capacity, or should we be trying to spend all of our money on grants? And we had a board that was fairly, this was a number of years ago, we had a board that was fairly well balanced on both sides of that question. So Andrew Chunalal, who's the CEO of Community Foundations, came in, did a presentation, and he benchmarked us against community foundations that were about our size across the country, and did a little bit of a presentation in terms of what other community foundations were doing across the country. It was a great tool to have a really robust conversation at the board level. So benchmarking against other community foundations, which, by the way, all of the community foundation data is available from the Canada Revenue Agency. And I think all community foundations also have access to a lot of that information that's been accumulated by Community Foundations of Canada and available through our website. So great opportunities to do some benchmarking there against other community foundations. And then there's a question of strategic operating reserves, on building unrestricted funding, often a key financial performance indicator for community foundations is how much unrestricted funding do we have? Do we have enough to cover our operations and the capacity building that we need going forward? Should we be doing any borrowing? There's a really interesting discussion now happening among foundations across, well, around the world really, with COVID-19. Should we be borrowing against our investments to try and get money into communities to support people who are struggling with, as a result of COVID-19 in the global pandemic? It's certainly a conversation to consider having at the board as to whether or not we could do more to get money out more quickly into communities. Does anybody have any questions about the tools or some of the things the boards can do to protect the long-term financial sustainability of our organizations? Seeing none, I'm going to move on. Okay, annual performance monitoring and control. Again, some of the tools here, having an integrated operating plan and budget. We have now at the West Van Foundation, I think our CEO and her team prepares about, it's a fairly extensive document. It's an operating plan. It's about 50 pages every year. It contains metrics and initiatives and key performance indicators, how we're going to measure success of each of the initiatives, along with a budget. And those two are really well integrated. In times of significant change and uncertainty, we tend to rely more on cash flow projections and scenario planning. I know at both West Van Community Foundation and Community Foundations of Canada, as soon as COVID-19 hit, we shifted our focus from budget compared to actual to cash flows and scenario planning. So, okay, what's going to happen to our cash flow? Are we going to be able to continue making grants? Can we, do we have enough money to keep the lights on? And what plans do we need to be making now to ensure our continued work? We're still looking at the budget compared to actual, but we changed things so much in both organizations that, and many organizations are doing the same thing, that often the budget that we built before COVID-19 isn't necessarily relevant to the operations that we're doing today. Performance planning and improvement processes, obviously regular board updates and reporting, and taking corrective action as required. At the end of the day, the board is ultimately responsible for the stewardship of the organization, and if they see the organization either spending above budget or not following the operating plan, it's up to the board to step in and take corrective action. And then finally, in our third area, financial risk management and asset reputation, these are the things that we need to be doing as an organization to basically protect the assets and investment of our community foundations, and to make sure that we're doing everything we can to reduce risk to the organization that something's going to come back and bite us. So we've got as possible tools, financial risk identification and management, processes. We'll have a slide on that coming up next, but actually taking a formal risk identification, taking time to go through a more formal process around what are the risks, what are the primary risks that we face as community foundations, and what are we doing to reduce the possibility of those risks coming to impact us. Do we have the right people with the right financial skills at our community foundations? Critical question. Again, community foundations so complex financially, relatively speaking. Do we have the right financial roles and responsibilities? Even in small organizations, you know, is it appropriate to rely on a bookkeeper? Does our bookkeeper have the skills that we need? Or do we really need a part-time controller and or CFO in order to make sure that we're doing everything that we need to do on the finance side? Do we have the right financial systems? Do we have the right financial governance policies? Are we following the right processes and procedures on a regular basis? Do we do appropriate skills training and education for our finance team? And are we in financial compliance with regulators and funders? That's an interesting one. We at the West Van Foundation, we recently went through a number of our gift agreements, and a number of the gift agreements we noticed had different definitions of income and capital. And that was interesting because I'm not sure how it's easy to treat each fund differently with respect to how we record changes to income and changes to capital. And yet, in order to stay in compliance with the gift agreements, in theory, that's what we should be doing. So it's really important to have somebody read through your gift agreements or your funding agreements periodically and make sure you're doing everything you can to stay in compliance with those agreements. And then there's, I guess, some tools that boards can use, getting really clear on a board mandate for your community foundation, given where your community is at and what you hope to achieve. What should be the role of the board? What's the board going to take responsibility for? Putting together a board work plan, putting together some goals for the board. What do we hope to achieve this year? How are we going to improve our organization? How are we going to build our capacity? How can we add meaningfully to the organization and not get in the way? There's some interesting research that came out of the US last year that was saying that there was a direct correlation between the level of engagement of most boards and the performance of the organization, but it was an opposite correlation. The more engaged the boards, the less performance the organizations had. So higher performing organizations had less board engagement, lower performing organizations had more board engagement. And what that said to me was that oftentimes, unless we really think about it, it's easy for the board to actually get in the way of the success of the organization. We hired a new executive director about 3 years ago, and one of her first acts was to reduce the number of our board meetings from monthly to quarterly. She said, if I have to prepare reports every month and do all this preparation, it's going to take time away from me being in community, talking to donors, talking to the community, building our reputation. And we told her flat out, we wanted her to spend 60 or 70% of her time out in community. Well, if she's having to prepare all these board reports and report every month, that wasn't going to be able to happen. So it's really interesting to think about the role of the board and how we can add value to the organization and not get in the way. Hopefully we all get to have some robust conversations about that. Okay, and here's, in a few minutes, we're going to go into some breakout rooms and have some conversations about this. One of the most interesting conversations I've had around the board table is talking about risk. And I've now done this at a number of organizations I've been on the board of. We've been through a formal, or let's call it a more formal, risk identification and management process. And by that I mean, we actually take some time out, either at a board meeting or we call a separate meeting, and spend a few hours thinking about the risks, the primary risks that our organization faces. And these are changing as time goes on with the global pandemic and climate change and Black Lives Matter, and there's all kinds of very interesting things going on in the world these days that in theory may require some change to the way we operate our community foundations. And my sense is that in many organizations, we don't actually take the time to sit down and talk about those risks and how they might impact our organizations. So we've seen it in a number of organizations now that where they take the time, it actually allows board members to sleep a little easier at night because they know that we've had the conversation. We've now got a pretty good understanding of the risks that our organization faces. And on a regular basis, we can think about how we're going to mitigate those risks and how we're going to address those risks. So there's typically 5 stages to a risk identification and management process. There's a process of going through, as I mentioned, just identifying the risks. What are they? What are the primary risks we've had? And then we assess those risks and prioritize them. So sometimes there'll be a few very high priority, these are the big risks, and there's all these other smaller ones, but here's the 3 we really want to focus on that are likely to have the most potential impact in our organization. And then go through the process of developing some controls and making some risk decisions about how much risk we want to keep ourselves, how much risk we want to transfer to others through insurance and other vehicles, come up with policies and internal controls, and then implement those policies and internal controls and make sure that they're operating effectively on an ongoing basis. So our experience is that organizations across the country are in a wide variety of states. Some have taken on this sort of very formal process and they have reporting back from the management team every 6 months. Other organizations have never had the conversation at their board, but are maybe interested in doing that. So we thought in the breakout groups, it would be really great if we could get people to break out, share for a few minutes what their organization's done with respect to risk management, whether they've gone through any kind of a formal process or whether they have an interest in going through a more formal process in the future. So Cindy and Tracy, if we could break, and I think Cindy, you mentioned that each of us, Cindy, myself, and Tracy will join the breakout sessions and have a bit of a conversation.
Yeah, we're actually going to do 2 rooms. So Gord, you're going to host one and Tracy's going to host the other, and then I'll pop in and out. So we've got about 7 minutes, folks, set aside for this. So just bear with us while we get you into rooms.
Looks like, oh, Gord, you're on mute still. Gord, yeah.
Wonderful, thanks, Tracy.
Gord, I'd like to
And
offer.
Gord, I was just going to say, Gord, you'll need to share your slide up again.
Right, okay, great, thank you. There we go. Okay, so how was that? I'd be curious to get, Tracy, how was the conversation in your breakout room?
Thanks, Gord. The conversation was really good. I'll be honest, we didn't have enough time. There was a lot of information shared, and what a lot of the basic pieces were, they've got good basic pieces in place, but moving forward for risk management into the future were some of the gaps that were identified. But looking at really, truly, those basic pieces of good policies, strong board support around the manuals, etc., was there. And really exciting to hear around risk assessments and looking at doing some risk analysis. So there is conversations happening, and really great conversations around ways that the foundations can move forward.
Wonderful. I wonder if it's possible for us to capture some of those and share them with all the participants. We don't really have time today to dig into that, but it'd be great to see if we can capture some of the ideas that came up in the breakout rooms and get them out to people.
I will be sharing a document that we have. It's a risk assessment document that is a really great template to how to utilize to examine all the different areas. An example for Prince George around insurance review. You know, doing an annual insurance review to ensure your insurance is in to the adequate level where your organization is, and it does cover the board of directors and the organization. So we'll share that document as well. Wonderful. Thanks, Tracy. Okay, there is a resource that if you're not aware of it, it's worth taking a look at, called Key Policies for Canadian Community Foundations. And I'll note that there is CFC is currently working on an updated policy manual, an HR manual, and some governance fact sheets. So these will be useful resources to look forward to in the future. With respect to the key policies document, here are I've highlighted in green the policies that specifically apply to finance and financial governance. If you don't have policies in these areas, it's worth taking a look. CFC went through and sort of highlighted which ones they thought were relevant for, I think it was smaller organizations and sort of mid-sized and larger organizations, so you can see which ones might be applicable depending on the size of your organization. Great resource to leaf through.
Yeah. Gord, can I just jump in here for a second? And I just want to build on a point that Beth Ann mentioned in that breakout room and around reputational risk. And, you know, as a sector, you know, charities are always held to a higher standard. We always see every year there's some article about, you know, bad charities, good charities. There's all kinds of, there's a number of entities out there that measure, you know, charities and whether those analytics are correct or not, it's a whole other conversation. But something like the We Charity scandal really, to me, highlights the importance of not only reputational risk, but the importance of having, you know, the right policies and practices in place, not only from a financial point of view, but from a governance point of view, because when something like that happens, everybody turns to look at what's in their own backyard. And you know, it clearly pointed out that we already had a number of cracks in their organization. But when it happens to one charity, it happens to all of us. And so we really need to ensure that we have the right policies, practices, procedures in place.
Absolutely, Cindy. I mean, it's a great point, particularly with what's been happening with we in the media these days. It goes to highlight that reputation can have a significant impact on an organization and community foundations in particular. Without a stellar representation, donors aren't going to be prepared to provide funds, and as a result, our ability to have impact in our communities can go downhill pretty quickly. So maintaining that, doing everything we can to maintain that stellar reputation, which generally means having well thought out policies, taking governance and taking our governance and stewardship roles and responsibilities seriously, not just showing up to board meetings and going through the motions, but actually having tough conversations about what we need to be doing to protect our reputations. And in particular, in these times of high change and uncertainty, do we need to be changing things that we're doing with respect to the big things that we're talking about these days, like COVID-19, Black Lives Matter, climate change, anti-racism? How do these big global issues impact our community foundations? And should we be changing the way we've been operating for years to try and, how shall I say, be a force for good? How can we create more good in our communities? We've had some really interesting conversations around the CFC board about the nature of philanthropy and community foundations' role in it. Arguably, there's an argument to be made that community foundations generally are following some pretty old models that reinforce colonialism and systemic racism. So interesting discussions for board members to have around that. But really, really important, because if we get caught falling behind and not thinking about some of these things, many donors may wonder whether we're keeping up with the times and will be effective stewards for their funds. So a really, really important topic. Okay, and just generally, we're going to take a break in a minute, but just generally wanted to point out that there are sort of 3 or 4 primary financial systems that boards need to make sure or ensure that the organization has good systems in place. First of all, around financial transaction processing. Do we have the right internal controls in place to make sure that we're recording our revenue properly, particularly with the fund accounting between all the funds? Are we making the right allocations between capital and income? Do we have appropriate bookkeeping and accounting systems that allow us to report both internally to our management team, externally to donors? Do we have the right budgeting and reporting systems, and are we using them well? And as we've just been talking about, do we have the right financial governance policies in place and governance systems to make sure that the organization is protecting itself? And somebody raised the idea of working boards versus governance boards. And as a working board, we tend to often working boards don't have any staff or have a very light staff complement, and so they do a lot of the work themselves. They get involved in operations and management and governance. And then governance boards tend to focus on governance, but that doesn't mean that we aren't required still to make sure, and this is why I say it's useful to do a periodic internal audit, that the organization has the appropriate financial processes and policies in place, and that it's adequately following those processes and policies on a regular basis. Ultimately, that is a board responsibility, and if we don't take that responsibility seriously, it's very possible that things may be going offside on an operating point of view, and we may not know about it for 2, 3, 4, 5 years, and it could potentially come back as a significant risk to the organization. So ultimately, it's up to the boards to understand the systems that they have in place and periodically essentially do a bit of an internal audit to make sure that the systems are appropriate and functioning effectively, particularly if there's been changes at the organization, if it's grown over time. There is a continued role there for boards with respect to financial governance. Okay, we've been at this now for an hour, so let's take a quick 5-minute bio break. You can leave if you put your microphones on mute, and you can, if you want, you can turn off your video, and then come back in 5 minutes. I've got 11:03, so if we come back at 11:08, we'll get started again at 11:08. Thanks, everybody.
Gord, do you need anything? Are you feeling okay with everything?
Yeah, so far so good. Thanks.
Okay, great. Fabulous.
Tracy.
Let me just give it another minute, Gord, and then we can get started again. Oh, you're on mute, Gord. Gord, you're on mute. I don't think he can hear me.
I think you can unmute him, Cindy, as host there.
Okay. No, I can just mute him. Okay, let me just drop him a quick note.
He's not showing up on mute anymore, so it's another setting here.
Yeah. I wonder if it's his headset or something.
Yeah, his headset may be turned off.
Yeah. Okay. Gord, you're on mute.
No, can he not hear us as well?
I don't think he can hear us either. Oh, isn't this weird? I just sent him a message, but.
I think it must be his headphone, but he can't hear us,
Yeah.
so it must be his headphone.
He can't hear it.
Yeah.
Bear with us, folks. We'll get this corrected.
Yes, thanks, everyone.
Not too sure how to. We know he's giving out great information here, folks.
We can see it on the screen here, yes.
Yeah. That is really, really weird. I've never had that happen before.
No. Yeah, I'm fairly confident it's his headphone.
Mm-hmm.
If you mess with his webinar part, he might stop because he'll be like, oh.
Yeah.
Oh, I'm putting my hand up to see if he can see.
Was my headset off?
Yeah. There you are. We got you back.
Everybody. Thank you for that.
So,
I apologize.
Short of just waving to you, Gord. Yeah. Yeah, so if you can just go back to where we came back, yeah, that slide, that would be great. Or the one you had just before that with the circles, the concentric circles, that would be terrific.
Okay. Okay, so we'll have to speed up a little bit. Okay, yeah. So regardless of what size organization you're with, even in the smallest organizations, there are a number of roles that still need to get done, notwithstanding that you're a smaller organization and you have fewer people. There are roles that a bookkeeper generally looks after. There are roles that a controller generally looks after, roles that a CFO usually looks after, financial roles that the executive director or CEO looks after, and financial roles for your treasurer and for your board members. And then there's also roles typically for your investment committee and your audit and finance committee. So regardless of how small you are as an organization or how large, these roles still need to happen. And so if you have fewer people, we need to make sure that we build up their position description so that the necessary roles are still being taken care of. With respect to the board, there's a few key roles the boards generally undertake. Are we receiving the information that we need to adequately steward the organization? Are there appropriately skilled people, including the bookkeeper and controller, CFO, treasurer, and appropriately designed systems for our organization? Have we identified the financial risks and are we managing them appropriately? Does the board have the appropriate financial management skills and understanding to evaluate the financial information that we're getting? And that's often critical. I've seen more boards get financial reports and have almost no robust conversation because nobody feels like they really understand the finances of the organization. So if you're not having robust financial conversations, it may be because your board feels uncomfortable with those conversations. So there's a lot of things organizations can do to build the financial literacy and understanding of their boards. And is the organization in compliance with its regulatory environment, which we'll talk about in just a sec. If we as boards aren't figuring out how to do this on an ongoing basis, we may be taking on potentially significant risk for our organizations. It's not enough just to show up and go through the motions. We really have to think about these questions and think about what we're doing as a board to make sure that we're fulfilling these roles. With respect to the roles of individual directors, the biggest role for most board members is to ask questions. Ask questions until they understand what they're looking at. And if they're reading and understanding financial statements, making sure that they're asking questions, the more questions they ask, the better, to the point where they understand it. Now, some of that they may want to do offline with a treasurer or controller, but asking questions is the primary role of the board members to satisfy yourself that the organization is doing everything that it needs to be doing, including on the finance side. With respect to a treasurer in community foundations, we strongly recommend that your treasurers are either somebody with a significant financial background, either a CPA or a CFA from the investment world, or a banker with significant financial expertise, somebody that can help boards navigate the financial information that they're receiving. Really doing the strategic thinking, developing the financial literacy of the board, making sure the board's meeting their their fiduciary responsibilities, educating the board on strategic financial issues, things like that. We don't like to see treasurers sort of down in the operations and doing the bookkeeping, for example. We see that in a number of smaller organizations where the treasurer actually takes on the role of doing bookkeeping, and then the governance role of the treasurer tends to go away when that happens. There are some fairly significant strategic financial issues that are unique to community foundations. Again, where do we draw the line between, do we have the view that we should try and be granting everything that we have and spending as little operations as possible? Or should we be investing in capacity building for our organization so that we can grow the impact we have in our community? Do we always have to run a surplus? Should we run a deficit in some years so that we can build our capacity and grow? Do we have the appropriate unrestricted funds to be able to do that? And should we do that? Do we have the right funding model and revenue streams for our organization? Are we charging the right amount of administration fees on our funds? Should we manage our own investments, or should we outsource the investments to a larger community foundation? Spending policy. Do we want to have a grant reserve pool? Many community foundations try and build up a granting pool so they have at least 2 or 3 years of grants in a pool in case investments go south. If there's a big drop in investments, they want to be able to continue granting at a consistent level. Should we be protecting the purchasing power of our endowment? Should we be topping them up with an inflation component to make sure that their capacity to grant in the future doesn't diminish over time? What are the key performance indicators, the key financial performance indicators we should be monitoring or measuring with respect to our community foundations? Do we have a handful of sort of 5 or 6 key financial performance indicators that we've agreed are the high priority pieces that we should be paying attention to? And what kind of financial reporting are we doing to donors? Have we reviewed it recently? Do we like the reporting? Is it easy for donors to understand? Yeah, so these are some of the key financial strategic issues that are unique in many ways to community foundations.
Gord, I was going to suggest too, I know I'll explain in a little more detail what our next session is about coming up, but one of the most common questions or discussions topics with a lot of the community foundations is around this, how we account for realized and unrealized gain income and defining capital. So we'll throw that into the mix for our next session.
Yeah, absolutely. I think is the next one on reading and understanding financial statements,
yeah,
and then the one after that is on internal issues like that, I think, right?
Yeah.
Yeah,
Yes.
perfect.
Yeah.
Excellent. Thanks, Cindy. And then we also have, and a few of these slides I'm going to go through quite quickly. I think you'll get a copy of the slides, so you'll be able to go through them. There are some organizations have separate finance and audit committees. Some do the two together. Certainly worthwhile to have at least a few members on each committee that have a significant financial background. And then there are roles for officers. Do you have position descriptions for your board chair? Do you have a position description for your treasurer? Who's responsible for maintaining adequate books and records and for making sure that you're in compliance with various legislations that impact your organization? To make sure that you're in compliance with your constitution and bylaws, and who's responsible for preparing the annual report. All good questions for most organizations. With respect to critical financial roles, here generally the roles of a bookkeeper, a controller, and a CFO. And even if you don't have a controller and a CFO, those roles still need to get performed. So are those roles performed by your treasurer or by your CEO or executive director? Now here we're showing the controllers generally responsible for the accuracy and completeness of the financial reporting. They're generally a CPA. They generally review the work of the bookkeeper and support the bookkeeper, make sure their financial internal controls are adequate, and reporting on the key performance indicators. These are things that generally bookkeepers don't have the skill sets to do. So if you're relying on a bookkeeper, you may want to have your treasurer, your executive director, or somebody else be reviewing their work and providing support to them. Same with the chief financial officer. Generally responsible for things like financial health and performance improvement, risk management, asset planning and preservation, managing investment relationships, managing banking relationships, that kind of thing. Again, if you're a smaller organization and you don't have people in these roles, the roles still really need to get performed. So who in your organization is going to take on those roles, and do they have the right skills to do them? In any organization, we need to find somehow segregation of duties and appropriate review, so that no one person should be able to perform all the functions within an accounting cycle and have the ability to cover up an unintentional or intentional accounting error or fraud, as we mentioned earlier. The more levels of review, the better. With respect to compliance, there's somebody in the organization needs to understand what the charity rules are and make sure that the organization's in compliance with the charity's regulation. That means we can't lend our registration numbers to nonprofit organizations. We can't, as charities, make gifts to nonprofit organizations. We can only use funds for our own charitable activities, and we can make gifts to other registered charities, not to nonprofit organizations. Let's see. Oh, changes in directors. Make sure that you notify the Canada Revenue Agency whenever there is a change in directors of your organization. You'd like to think that's taken care of when you file your T3010 report. Not true. That's for public information only. The CRA does not update their database of who is authorized to speak to the Canada Revenue Agency on your organization's behalf unless you file a change in directors form every time there is a change of directors at your organization. Really a critical piece. We've seen organizations get to the point where all of the original directors or all of the directors that have authorization to speak to the Canada Revenue Agency has since left the organization, and nobody at the organization actually has authority to speak to the Canada Revenue Agency. It can put you in a bit of a bind trying to get that access back. With respect to the regulatory environment, there's incorporation legislation, fundraising legislation in some provinces, I think like Ontario and Alberta and maybe others. So you got to understand which legislation you're required to be in compliance with. let's see, payments to directors. There's limitations in some provinces on what kind of payments you can make to directors. So be aware that you should be, somebody in your organization needs to know what those restrictions are. We talked about a periodic internal audit, policies and procedures. I'm just going to go through that fairly quickly. Okay, strategic financial governance. Investments. Here are some interesting questions for organizations to deal with strategically. Should we have one fund or multiple funds? Should we have a long-term fund for endowments that can afford to take more risk and earn higher returns? Should we have a midterm fund for other funds? And should we have a short-term or money market fund? Or can we manage this all in one fund? Great question for organizations to think about. Policies. Do we have an investment policy statement? Do we have a statement of investment beliefs for our organization so that we know that we're managing our investments to a strict policy? And should we consider outsourcing to a larger community foundation? Often it's difficult for smaller community foundations to have the expertise to manage significant sums of money, and as a result, donors may be hesitant to provide them with significant funds. But if they outsource their investments to a larger community foundation that has more expertise, donors may be more willing to provide significant funding to the smaller organization. So certainly worthy of discussion on those three issues. Some other questions. Do we have the right business model? We'll get to that in the next slide. Again, are we spending the right amount on overhead and capacity building? Should we consider outsourcing our back office? If we're a very small organization, should we be outsourcing the bookkeeping and accounting and investment management? And have we identified the key financial performance indicators that are relevant for our organization at this point in its life cycle? With respect to the business model, these are some of the things we're talking about at CFC. And there's no right answer for community foundations across the country, but these are questions I think that we need to now be thinking about and talking about. Typically we've relied on older white donors across the country. We've focused on building endowments, which in many respects is building of power. We've invested in capital markets, capitalist capital markets, not necessarily ethical investments or community investments, which often puts a focus on sort of these older white donors who may be out of touch with what's currently going on in society. And many community foundations are funded by a percentage of the assets, the administration fee, so we have an incentive to accumulate assets and grow power. And in the future, some questions we should be at least thinking about are, is there a way for us to democratize philanthropy, to share power with our community members, to share power with the communities that we serve? We've talked about at CFC, we're talking about focusing on the UN Sustainable Development Goals and thinking about other ways to earn unrestricted funds other than on administration fees and a percentage of assets under our control. So some interesting questions there for community foundations to deal with as we think about our business model and how we earn our revenue. With respect to overhead and administration, we've come across many board members that are convinced that grants are good and overhead is bad. We should take every last penny that we get and we should be making grants with it. There's an argument to be made for that, but there's also arguments to be made for building capacity and running deficits so that we can build our capacity to have more impact in the future. And there's opportunities for outsourcing, as we've mentioned. And then the last slide before we open it up for questions is, have we as community foundations really thought about the key financial performance indicators that are relevant for our organization at its stage of development today? Are we tracking the surplus versus deficit compared to budget? How do we track and measure our investment performance? Do we have the appropriate amount of unrestricted versus restricted funds? What type of donations are we getting in historically, and what type should we be going after in the future? And again, are we relying on the fees charged as a percentage of assets to fund our business? And if so, what's the appropriate level of fees for those? So with that, Cindy, I think we've got a few minutes for questions, do we?
Yeah, just a couple of minutes. A lot of information here, folks. If you do have a particular question right now, now's the time to either unmute yourself or pop it into the chat box before we sign off. And while we're waiting for people to do that, I just want to mention that Tracy and I will both follow up with documents around the risk management review, the one on legal issues, and some links to a two-part webinar series we did last year with Tony Macklin from the National Center for Family Philanthropy in the U.S. around business models. And as Gord said, it's an ongoing conversation. You're going to see this come up more and more often around our work as community foundations and philanthropy in general. So lots more to come up. Anybody have a question?
And Cindy, I'm happy to take questions from people. I don't know if you want to share my email address and phone number, but yeah, I'd be happy to take questions after the presentation if anybody wants to follow up to discuss something specific to their organization. Okay, wonderful. Also, just to remind people, if you want to just flip to the next one, Gord. So our next session is on October 15th. And so on that one, we're going to really delve deep into, reading and understanding Community Foundation financial statements, the reports that we can create. Those are donor reports, other reports, our filings, our T3010 in particular, and the most common mistakes that I shouldn't say almost, but so many community foundations make. We'll also delve into gift agreements because I know, Gord, you touched on that. It also ties into some of the legal issues. Scott, I think about, some of the changes, as we see change in leadership, change in legislation, all these things about some of the challenges that we have with old fund agreements and how we can move forward on this and some of the definitions around, as I said, realized, unrealized income, defining capital, and so on. And then we have on September 24th, our first of a three-part around governance fundamentals that Tracy is going to be leading. October 22nd, partnership with Green Shield Canada around corporate philanthropy. They've put together a really great toolkit and their work with community foundations. And then on the 29th, governance fundamentals, part 2. So those are just a few that are coming up, and so stay tuned, and you'll see them come out in the digest if you have not already seen it. Tracy, Gord, any questions you want to fire out? Please do so now.
Just also want to add as well that you will receive an email right immediately after this event with a survey. We really value that you've been able to come on board with us today, and we value your input and your thoughts around how today went and ideas and things that you're looking for the future. As Cindy mentioned, we've talked about defining capital, unrealized, realized gains. These will be pieces we'll be talking with Gord about to add to the future, but we do also want to hear from you in the survey if there's other topics as well.
Yeah, so I know we threw a lot of information at you, or Gord did, and Gord, thank you so much. I think the next one, we'll delve into a little bit more smaller groups, and I know lots of Q&A will happen as a result of, talking about reports, because it always comes up. So thanks so much. And Gord, thank you. Appreciate the time you took. Appreciate you being up a little bit earlier on the West Coast for us, and thank you to everyone who joined us today. Really, really appreciate you taking the time out of your day to be part of this learning. We know your days are full and busy. So on behalf of Tracy and myself, and I think Gord from the CFC board, just thank you so much for everything you're doing every day.
And Cindy, thank you to you and Tracy for your hard work on supporting sessions like this.
Our pleasure.
Yes, thank you so much.
Okay, well,
thanks everybody.
Yeah.
Okay,
bye-bye.
And take care. Bye-bye.
Bye. Okay, I think it went well, folks.
It did. Do you want to stop recording for a second there?
Yeah.
Awesome.